What's up, you guys? Welcome back to the Capitalized Podcast, where we help investors build wealth in real estate. I'm your host, Grant Smith. As always, this podcast is sponsored by our private lending company, Sharper Capital Partners, where we help investors build wealth with hard money. If you have questions about how to use hard money to scale your real estate investment portfolio, you can visit us at sharpercapitalpartners.com. All right, so on today's episode, I'm super excited to welcome Slocomb Reed. Slocomb is a good friend of mine and is an apartment investor here and real estate entrepreneur based in Cincinnati, Ohio. His businesses include a rental portfolio, a property management company, a construction company, and an HVAC company. If I could go on one tangent about Slocomb here really quick before we get started, it's that he has been a leader in connecting new and experienced investors here in Cincinnati, Ohio to the real estate community. And so a number of us in the community have found a number of helpful resources through Slocomb. So without getting too far into it, we just want to say thank you for all that you do for the real estate community here in Cincinnati, Slocomb. So without further ado, welcome to the show.
I appreciate that greatly, Grant. Thank you. I feel like you were saying a lot of those nice things just to put pressure on me to not make as much fun of you as I normally do. For those of you who are listening, I just listened to your interview of Eric Gross. Cool backstory on how the two of you met. I didn't realize you knew each other that well. Of course, I know Eric as well as Grant. I met Grant by coaching high school rugby against him back in the day. I was coaching forwards for Walnut Hills High School, and he played for Lakota.
Yeah. So a bunch of interesting backgrounds. One of the things you'll find here in Cincinnati is everyone seems to be connected in one odd way or another.
It's the world's largest small town, for sure.
Yeah. So it's terrific just to have these episodes on here. If there were two that I wanted to get on here, it would definitely have been you and Eric Gross, because we just have, again, fun connections to our stories. But before we get into your story about how you got into real estate and everything that you're doing currently, why don't you go ahead and just tell the audience, okay, what are your current focuses professionally and what your real estate holdings look like?
I'll start with the holdings. I personally, and then with some joint venture partners, own, I think it's 86 units right now. It depends on how you count. One of the properties is complicated. It's my office. How many units the office counts as is kind of amalgamous, but and that's why I say 86-ish or 84 or 80, depending on how you look at the office. It currently has 9 tenants. So I'm 2 of those tenants, but that's the current portfolio. The rest of it is apartments, all in the greater Cincinnati area, acquired from 2014 through 2022. And my current real estate focus is on operating companies for a couple of reasons. One of them is I'm happily married. My wonderful wife, Leslie. I have 2 daughters, one who's 4 and one who is newly 8 months old. And so I have a greater need for cash flow now than I ever have before. And operating businesses generate cash flow faster than buy and hold real estate does. So that's one of the reasons. The other is that I said 2014. Ever since 2014, as my portfolio has scaled, I've needed access to more and better resources to continue to manage and maintain that portfolio. And so I have tended to hire full-time people as soon as I needed someone part-time, just to know that I had them available to my own portfolio on a full-time basis. And then I have taken the other time of theirs that I haven't been able to keep busy or keep profitable myself and effectively provide that service to others. So, pairing my own owner operation with property management and then with construction management, those were very natural segues, and I needed to do property management and construction management anyways. The HVAC was a little bit different. That was several happy circumstances colliding all at once and me realizing it basically fell in my lap.
Yeah, that's one of the things that we're definitely going to highlight in this episode is how you have built out basically the services you've needed to manage your own portfolio and how you've leveraged that to start businesses where you can service others too. But before we get into the nitty-gritty details of that, let's back up. You choose a point. When did investing in real estate come on the radar for you?
March of 2013. I was engaged. I was going to get married in a couple of months. I was a quote unquote full-time professional youth minister. I was being paid for 25 hours a week. The amount of effort involved was full-time. My wife had a full-time job working for a copy editing company. And actually, I think at that point, she was actually in the nonprofit sector sponsoring education programs in Guatemala already. But she was getting paid for 40 hours a week and I was getting paid for 25. And so I had a handful of side hustles, just trying to make up that like 15-hour gap so that we were contributing equally financially to our families. And then in March of 2013, I finally read Rich Dad Poor Dad, a book that had been recommended to me for a few years already. It lit a fire under me. I read a bunch of other Rich Dad books, within the Rich Dad company, the Ken McElroy books, the Garrett Sutton books. And I figured out, I didn't know it was called house hacking yet, but I figured out that you could own or occupy a multifamily up to 4 units on an FHA loan and only put down 3.5%. And I was off to the races. I just had to. And so fast forward from March, that fall, I was married and looking to buy. The next February on Valentine's Day, actually, we closed on our first house hack. What I found, if we could just talk about the house hack again, we're recording in 2023. 2023 financials for rental real estate and 2014 financials are very different and not relatable, to be fair. So I don't want to I don't know how helpful it would be to dive into 2014 numbers right now. But long story short, self-managing my house hack was significantly less than 15 hours per week on aggregate. When I had a vacancy or I had a renovation, it was of course more, but on aggregate, it was way fewer hours, a way bigger financial return for us than any part-time job I would have been qualified for. And I was off to the races. It turned out I was good at dealing with people. I was bad at all of the mechanical and maintenance stuff, but I was good at dealing with people. I wanted to get full-time into real estate as fast as possible. A youth minister's salary is not that hard to replace. So I became a residential sales agent, joined a team, spent the next few years learning everything I possibly could while also doing some transacting and making some money. And I was off to the races. Is that what you wanted?
Exactly. I mean, one of the points that I wanted this to lead into, and you kind of touched on it, was how you and your spouse kind of got on the same page about what you were trying to do in real estate, because I think that's a big hurdle for a lot of people. They might say, oh, even what you're doing now where you have children and you're, still house hacking essentially. But in those early days specifically, was there a lot of hurdles in your relationship to get on the same page about what you were trying to do in real estate, specifically with a house hack where you're living next door to your tenant?
That part was relatively easy, all things considered, in part because I had a great relationship with my spouse. Also because we were looking to improve our lifestyle at the same time that we were buying our house hack. We were apartment dwellers at the time, paying rent to one of the larger companies here in Cincinnati in a relatively rundown old building in a fun neighborhood that is more trendy now than it was at the time. And given the locations we were most interested in, we were going to have a nicer, bigger apartment in a more interesting building in a more interesting neighborhood with more walkable stuff. So house hacking for us signified lifestyle improvement while also signifying financial gain.
Awesome.
So all things considered, it wasn't that hard. If we talk more broadly about the other risks that people are considering when first getting into real estate, a couple of the ways that I thought my risk was going to be mitigated, thinking as a newbie who hadn't bought anything. The first is I'll be living there. So every day I will have firsthand knowledge of what is happening at my property. The adverse of that being an experience is that the day of closing, we went back to our apartment in the building we didn't own, and I couldn't sleep because what if the roof caved in that day because I owned it, right? And I freaked out and I was like, Leslie, we've got to go sleep on an air mattress tomorrow night with no furniture in the house that we own, just in case something bad happens. I'm freaking out. Of course, nothing happened. And of course the tenants just took the ownership transition and paid their rent to me on the first of the next month instead of paying it to the old landlord. Like none of the things I worried about actually came to fruition. The other mitigating factor for me was the 3.5% down. It just wasn't going to take enough. It wasn't going to take much money to do this. And I figured if real estate prices go down and we lose our equity, then we still have rental income covering the expenses. We won't be forced to sell. And if this was a terrible mistake and we lose our money, we're still only talking about losing 3.5%. So I wasn't, the lack of capital required to house hack and the fact that I'd be living there with firsthand experience of everything happening at my first rental property, those felt like mitigating factors at the time.
Got you. And I think you hit on a key point there about what are some of the major hurdles that people try to overcome when they're doing their first deal. One of them being the capital, which you discussed. Hey, you did 3.5% down, FHA financing. But the other two are probably finding the deal and then any construction that's necessary to get the property rent ready, which in your instance may or may not have had any. But could you just address those two for that first deal that you did? Where did you find it? And then was there any construction that needed done?
No construction on the first deal. We were particularly looking for things that didn't require any renovation because we didn't have any real experience with it. My wife had done Appalachian Service Project a couple of times while she was during summers in high school, and that was the extent of our renovation experience. Having tenants and having people pay us rent and dealing with their complaints was the rung to our comfort circle that we were going to expand first pretty intentionally. Like we wanted that to be the one thing we really had to learn how to do with this first one. We also weren't looking for a major project. We were just looking to move into a new place. And then Slocomb needs to be able to handle everything this thing needs in 15 hours a week or fewer. So no renovation there. That would have felt like too much for us at the time. How did we find the deal? The unrelatable answer is we got it under contract in 2013. Anything you bought in 2013 worked. So you can't just go to the MLS and like close your eyes and say, okay, I'll take that one and I'm going to make a lot of money, because it's 10 years on, 10 years, at least 8 or 9 of them being crazy bull market, regardless of what market our listeners are in. And so I would say when it comes to finding your first deal, I want to answer that question differently. What I really want to say is that all of us, the listeners, of course, included, need to spend more time focusing on what it is we need from a deal and then buy whatever meets that criteria. However it is that you find it. There are a lot of people nowadays who are talking about how you have to get off market and you have to send mailers, and you have to send 5 times as many mailers per deal now than you did 2 years ago. What I find is that the vast majority of people haven't spreadsheeted out or even just put on paper the actual return or the actual lifestyle change that they want from their first deal. So they're not comparing their deals to their goals. They're comparing their deals to what it seems like everybody else is getting, and they want it to be better than what everybody else is getting. And so they feel like they have to go off market and send 10 times as many mailers to get their first deal, when really what they need is to accomplish their goals. So indirect answer to your question, don't worry as much yet on where your deal is going to come from. Focus first on what your goals are, what's actually going to make a difference in your life with your first deal. And then get that written down. And when you know what that is, you'll be able to see it in the right deals, whether they're on market, off market, mailers, cold calls, door knocking, a real estate agent, whatever it is.
I think that is such a huge piece of advice for so many people, because if you sit in a room and, Slocomb, you run the best ever CRE meetup here in Cincinnati. We go to a bunch of meetups where we bump into each other. If you sat every investor down and asked them to say what's their desired rate of return, or what investments are they interested in, or what's a deal versus what's not a deal, might be the most general way of stating it. There's so many people that will it's a different answer for everyone. And so I think you hit the nail on the head where a successful project looks different for everyone. Obviously, there's probably a few key rules that make it a success versus, a few key rules that don't make it a success. But in general, like you said, it really comes down to an individual's like perspective and what criteria they're actually looking for. I'll speak a little bit to, the project that we're working on where, we run a private lending company. Hard money lending company is probably the correct way to state it. And
you know that I'll make fun of you for that too. That's why you're correcting yourself in advance.
Yeah, right. I mean, right now it's mostly my personal capital gets deployed, so I can still probably get by with that. But the correct way of marketing is probably hard money. But we have done, close to 40 loans at this point. Over 50% of them have paid off, no defaults on record. But there's still so much to learn that investors face, and I've always wanted to own assets myself. And so we recently acquired this duplex. It was on market. Needed some, the investor was incentivized to sell. The person who owned the property was highly incentivized to sell this thing quickly. We came in, made an all cash offer and closed on it in 6 days using, again, our resources that we had at our disposal. And it was one of those things where the deal for a lot of other people probably might have been a little tighter than they would have wanted to go. But for us, it made perfect sense and we got experience out of it. And you learn so much just by doing deals instead of just loaning on them, which has been the whole point for my business in general. But to your point, I just want to reiterate that it looks different for everyone. And so people shouldn't get too hung up on that.
I have one more piece of advice that I really feel compelled to add here, Grant. Especially with newer investors, but for all of us, when you're thinking about your goals, let me take the perspective of an investor-friendly agent or agent investor, which really was, I still am, and it really was my core focus for at least 5 years, to be the real estate agent representing other investors, particularly residential investors, but a little bit of commercial multifamily, and mixed use. When I asked people what their goals were, almost always the answer was, I want a duplex. And the conversation that ensued from there, guided mostly by me, was that when I want to hear my clients' goals, I don't want to start with the property that they want to buy. I want to start with the result they want from owning real estate. Let's start there. What is it that's going to change about you, your life, your lifestyle, your relationships as a result of getting into real estate investing? And then when we know what the result is that you want, it's fun. All of my hand gestures are happening underneath the camera. I'm just going to roll with it though. Your viewers will just have to not see my hand gestures. Once we know what the result is that you want from the effort and the capital that will be involved in real estate investing, then we can talk about what strategies are available to you that can help you accomplish those results goals. And when we have a strategy, that's when we can talk about what kinds of properties you need to be looking at and what kind of condition and location they need to be in and what skills you need to focus on learning first. I spend a lot of time talking to new investors about their goals, if you can't tell, and making sure that they're focused on the results that they want, the reason for the effort and deployment of capital that they're looking to do. Those are the people who really find success, the people who have some motivation internal to themselves, external to the property that they're buying, that they're looking to accomplish, and then they figure out how.
Again, that's great pieces of advice there. And I kind of want to go along that thought because obviously you've had a number of conversations with investors defining their investment goals. So at some point you decided to become that sales agent for the Chabris Group, which is they state they're the number one sales agency here in Cincinnati, which I don't know if that's off transaction volume or if that's just a marketing shtick, but either way, they're highly successful. What made you decide to become an agent? And, at what point did that fit into your career and how did it ultimately play out?
I think I've got 4 things here for you. The first is that since 2012, the Chabris Group has sold more homes annually and cumulatively than than any other agent or team in the market. If you're looking at total sales volume, it's been much more competitive the last couple of years. It's not just the Chabris Group blowing everyone out of the water the way that they had for so long. But when it comes to number of homes sold, number of transactions per year, the Chabris Group still takes the cake. Peter Chabris will tell you they're a unit shop, that they're looking to do as many transactions as possible, serve as many people as possible, and they're still thriving in that regard. I'm currently the director of investment services with the Chabris Group, meaning that less of my time is spent with an investor in the field finding their next deal, and more of it is spent with our investor clients and with our agents themselves, advising, frankly, on what their goals should be and how they should be finding the results that they want from their real estate investing activities and deployment of capital. But I am now a step removed from the transaction in a much more advisory role, helping agents invest for themselves, helping agents better represent their clients, and helping some clients better invest. What was I looking for from becoming a real estate agent? I already made the true joke about a youth minister's salary being easy to replace. But part of it was that I was looking for a way to get into real estate full time. I wanted to be immersed in learning the market, learning the industry, developing relationships, developing some skill sets, gaining some experience. I had a conversation with a very good agent early on where he told me he was looking to minimize the number of transactions he had to do every year to make the same amount of money. He was a seasoned veteran in real estate sales. And my thought was the opposite. I want to sell as many houses as I possibly can in a year in the same amount of time worked, because each transaction is its own experience and I need all those experiences to learn from. It was more about how many transactions can I get into and learn from than how much I was getting from each commission check. The plan was always to transition sales back towards my own investing full time. That's where I am now. My first house hack closed in February 2014. My second deal didn't close until early November of 2016. And then I did a couple little things in 2017, mostly like wholesale type stuff. And then in 2018, I was off to the races. I say off to the races, obviously, the growth was more exponential than linear from 18 to 21 when I was building the portfolio. But how did being a real estate agent wind out, or frankly wind down? I got very good at a few things that real estate agents need to do. At the same time, and a lot of people who started out as my clients are now very good friends. You haven't played poker with us yet, Grant, but a lot of my agents are now full-time real estate investors themselves, sitting around the real estate investor poker table. Used to be once a month. We really need to get back to doing it once a month, and you need to come so I can so that I can win your money. I will say another reason for the professional transition to starting and running operating companies. I in the last couple of years, I would have made more money faster just being a real estate agent. However, in order to be a good real estate agent on the listings, on the seller side or the buyer side, but especially on the buyer side, you have to be available to your clients in the moment that they need you. That's just the way the market works now. When the right property or a great property lists, it's going to pen quickly. And you need a buyer's agent, especially, who can pounce, get you in it if you need to get in it, get your offer written, have the conversations required with the listing agent, do the negotiating, get you under contract. They have to pounce in order to be able to do all of that. And if you're a listing agent listing good properties, you have to be ready to get pounced on by lots of agents who have buyers who are interested. The number of transactions is down. Overall demand is down in the market, but overall supply is down more, which is why in a market like Cincinnati, we're still seeing appreciation even as we wrap up Q2 in 2023. Overall transactional volume is down, but demand still outpaces supply. And that makes this a market where agents need to work nights and weekends. I have two daughters now. I want to be a very involved dad. And man, being a very involved husband is a lot more difficult right now too. As busy as I am professionally, and has how much of our time is taken up with just taking care of our kids. I need to be able to turn off work now in a way that I just didn't before when I was really hustling, chasing the real estate agent game. And so the way that being an agent takes your time just wasn't a fit for my lifestyle anymore. It wasn't a fit for what I wanted from life. I wanted to be available to my wife and daughters outside of business hours. And so my professional transition has been in large part to make that happen.
Again, yeah, that leads into some points I want to hit on here later in the episode. But for right now, I want to kind of get back to the portfolio that you built, the real estate portfolio that you built. So 2014, you're acquiring, you acquired your first duplex. 2016, you acquired another property. And then things started to take off in, I believe you said 18 or 21?
From 2018 to 2021, yeah.
And what was the catalyst for that? Was it paying down the knowledge gap, or what was the catalyst for the significant portfolio growth there?
By 2018, quick note, the 2016 deal was a Burr 3-family. For your clients who may not be aware, Burr stands for buy, rehab, rent, refinance, repeat. Imagine flipping a house, but then instead of selling it, you put a tenant in it. You refinance all of your cash back out, and you keep the equity and the cash flow and the property long term instead of selling it for maximum profit day one. Also maximally taxable profit day one. So 2016 was a Burr deal right around the corner from our house. So first deal was a house hack that ended up going brilliantly well. Again, a rising market raises all ships. So I had done a Burr deal. By 2018, I had helped enough clients through Burr deals, house flips, buying stable buy and holds, that I started to really feel like I had some expertise and the ability to execute on more deals. I also, in 2018, brought on an investor client who became a business partner, who I found him an amazing deal on a duplex, which is what he told me he wanted. His goal was a duplex, right? He, amazing deal on a duplex. The very soon after we closed, he came back to me and he said, "This is an incredible deal. I am very happy. It's still going to take me 8 years to get all of my money back. And I'll have cash flow after that, but it's going to take me 8 years to get all the money back that I've put into this thing. If I'm underwriting conservatively, the deals that you're doing, you're getting all the money back in 12 to 18 months. I want to do that. If you'll do it with me and you'll find the deal and execute on it, I'll bring all the money and we'll go 50-50. And I said, "Yes, please. Thank you." And so that's also kind of where it went off to the races, is that I had a capital partner, joint venture. I had a capital partner who wanted to do these kinds of deals. I had the ability to find them. Hindsight being what it is, 2018 was still a great time to be buying Burr deals. It didn't feel like it at the time because of the accelerated appreciation that we were seeing coming out of the Great Recession. Everybody, it's hard to remember now, but in 2016, 17, 18, 19, 20, 21, and the beginning of 22, we all thought the market was going to top out sometime soon, just because of how much appreciation we were experiencing. But there were still deals to be had that were not that hard to find. And so all of a sudden I had the expertise. The expertise was paired with somebody else's money. And I was able to take down deals myself at an accelerated pace because I had access to significantly more capital than I had myself.
Yeah, no, that makes perfect sense. So at what point did you decide, hey, I have amassed this real estate portfolio, and I need to start fleshing out other operational businesses? Because, those are two different things, obviously. And I'm curious at what point you're saying, hey, like I want to build up the property management company and all those things. So like what order did you start those companies in? And what was the decision to go ahead and start those companies?
You're putting a very positive spin on what was experienced fairly negatively in the moment. So I was still finding a significant number of solid deals into 2021. And my issues towards the end of 2021 were not about the deals I were buying. They were internal operational issues within my own self, if I'm being frank, but also within my own operations, my property management company at the time. I didn't technically start my construction management company until I think it was technically January 1st, 2022. I over acquired towards the end of 2021. I over acquired based on what I personally had the operational capacity to get across the finish line. If I'm being really frank, it didn't help that in the fall of 2021, all within a month of each other, I let my property manager, my property management employee go. I had my 2 full-time W-2 rehab and maintenance guys quit, and I had 2 general contractors ghost me on rehabs, like whole house rehabs, all at once. That didn't help, of course, with my operational capacity, but I also didn't have the perspective to realize how thin I was stretching myself. I also had some pretty important goals at the time. I bought enough properties. I'm saying all of this because of how much value I think your listeners are going to be able to get out of some of these things. I know some of this is relatable, as much as some of it's not fun to talk about. I was so close I perceived myself to be so close in the fall of 2021 to having enough income from my portfolio and the management of my portfolio that my wife wouldn't have to work anymore to sustain our lifestyle. And so as soon as I felt myself getting close, I bought everything I thought I would need to accomplish that goal so that I could tell my wife that the goal had been accomplished and she didn't need to work anymore. I rushed it. And I put myself in a position where I had too many projects. I had too few resources. I don't know how I could possibly have anticipated all of the letting go, quitting, and ghosting that happened all within a month of itself. But I put myself in a position where I had too many things I needed to do in too many places. My capital needed to be deployed all at once. And all of the projects I took on in the fall of 2021 took twice as long and twice as much money to get across the finish line as I expected. So in part, the transition to operating companies was out of necessity. I needed to build out my own operations to get those things across the finish line. I've also recognized ever since my portfolio hit 40 units, and it hit 40 units with the acquisition of a 24 unit. So it went from 16 to 40 overnight. The same month my first daughter was born. I recognized that, let me put this in 2023 terms, what I was experiencing in 2019. I recognized how valuable it would be to hire people full-time that I needed part-time, but could make available to myself full-time, as long as I was also able to sell their services, sell their time to other people to bridge that gap between part-time and full-time employment. The best example would be a handy person, maintenance technician. When you don't have someone working for you, it is a bear. It is a slog to get people to come out and fix your little stuff, because quality skilled people don't want little projects. There's so much loss for them in taking the small projects when big projects are available. I'll leave that there. But one of the first things that I did was hire someone as soon as I possibly could justify it financially, knowing that I would need to sell. I would need to offer maintenance services, property management services to other people. I needed to focus on operating companies to get my own stuff across the finish line. I also, in very soon after the fall of 2021, my wife was pregnant with our second child, which meant greater financial need, greater short-term, immediate financial need for my family, as well as larger draws on my time for my family. And when compared to cash flowing real estate, cash flowing businesses cash flow bigger and faster. I can make significantly more money right now installing furnaces and air conditioners than I can collecting rents. And when I started facing that, I want to say when I started facing that reality, but also when I started recognizing the opportunities that were available to me, because I was starting to put together people and teams of people who were quality technicians and quality providers of the services that they could provide. And I recognized that I had the opportunity to sell those services, whether it be property management, construction management, HVAC. When I started seeing the potential that I needed to unlock, I started turning those keys.
There are so many good points in there, but just to reiterate what I heard is you had these holes in your business from a real estate portfolio's perspective, and you chose to build them with operating companies. While you couldn't afford those employees solely to service your own portfolio, you could afford them full time if you would broker their labor out to other people who needed them, which anyone in the real estate community around here, if you go to any of the meetups, they all need the same things. They need property management, contractors,
and property management. Yep.
So you're certainly becoming the one-stop shop here in Cincinnati. But a point that is really worth noting, a cool tidbit, right? That 24 unit that you acquired, that was Brandon Turner's 24 unit, correct? Here in Cincinnati, Ohio.
Yeah, we can, I have Brandon's permission. We can tell that story if you want.
Awesome.
So I found that 24 unit off market earlier on, late 2017. I found it off market at the same time that Brandon was selling and 1031 exchanging out of his 24 unit in Washington. I have a feeling we're going long on time. So 1031 exchange may be something that your listeners need to Google if they're not familiar with it already. Basically, it put a time crunch on Brandon buying some stuff for some tax advantages. He ended up, a clever thing Brandon doesn't talk about, but that he did in his 1031, he put 3 properties under contract, knowing that he needed to buy 2 of them, giving himself the wiggle room for one of his deals to fall through. So that's something that he doesn't talk about that he did that was immensely clever. He only ended up buying 2 because he only needed to buy 2, but he put a 3rd property under contract just in case one of them blew up after his 45-day identification period. Again, Google that if you need to. And those the 2 properties were the mobile home park with Ryan Murdoch in Maine, which obviously has led to Open Door Capital and on all of the amazing things Brandon Turner is doing, even with his own Better Life podcast right now that I'm an avid listener of. The other property he bought was the one that didn't work out for him, which was the 24 unit in the greater Cincinnati area, which I sold him. I don't know what it is. I guess most people who listen to the Best Ever podcast, or at least listened back then, didn't listen all the way to the end. But Brandon Turner did a couple of things right at the end of the podcast. And one of them was, hey, I'm 1031ing. I need to buy some stuff. If you have any deals, shoot them to me, like shoot them to my email. Well, I emailed him, and like within 5 minutes, he emailed me back and told me he'd call me in 45 minutes. And I was just like starstruck, goosebumps. Brandon Turner is going to be calling me in 45 minutes. But long story short, it was an incredible deal when I sold it to him. but it's like a C+ property in a C- area. And both of those letter grades might be generous. So he bought it with me. I sold it to him as his agent off market, just took a commission, not a wholesale or anything fancy. But then he hired the wrong manager 3 times. And he was living in Washington State. His operations manager was living in Maine. They were both in the process of moving to Hawaii, busy and not local. So again, with the struggles that Brandon had with the property, he just put out at the end of the podcast after the outro and all that, hey, I'm thinking about selling my property in Cincinnati. If you're looking to buy apartments in Cincinnati, hit me up. And I'm the only person who reached out. I think I might have been the only person who reached out who already had his cell phone number, but I reached out and said, hey, I'll buy it. And there are a couple of cool tidbits in this story that I want to get to that I think will add value that I haven't shared on a podcast yet. But he hired the wrong property manager 3 times. The property was in worse condition than when I bought it from him, all resulting from poor operations. Fewer occupancies, lower quality of tenant base, just because the property management had been poor. And so we were having this conversation in April of 2019. And here I am thinking I'd love to put together some creative deal structuring here in this deal with Brandon Turner, but this is a deal with Brandon Turner. Why would I come up with the creative deal structure? Why wouldn't I just let him do it? And so I posed to Brandon, hey, I wanted to ask the question, not answer it, because I knew his answer would be better. The problem that you're facing, Brandon, is how much of your time and your money is being sucked into dealing with this thing. I'm local. I can start dealing with it immediately, way faster than I can buy it. How can we structure this deal so that I just take over all the headaches, I take over all of the issues as soon as possible, and you give me time to secure financing, capital, et cetera? And what he came up with, which was brilliant for both of us, was a 90-day close where he would sublease the property to us, allow us to collect all of the rent, keep all of it, and pay all expenses except for his debt. He would go ahead and pay his mortgage payments on our behalf for those 3 months, which would total around 10 grand. We'd increase the purchase price we had verbally agreed to by 10 grand to pay him back. But we would go ahead and take over management of the property as soon as possible. And we'd have 3 months of no cost of debt to start turning it around before we had to actually buy it. And of course, if we decide to back out, Brandon either has all of the problems he had 3 months ago, or he has a property that's in an improved condition because we actually did some stuff, or he sells it and effectively breaks even on what he bought it for 18 months ago. What we inherited in that 24 unit was 15 tenants, 9 of whom wanted to pay rent. So we really, a month in, had 9 tenants in a 24 unit building. And we had the opportunity to use those 9 rents and then 10 and 11 and 12, et cetera, without any cost of debt, just paying the low utility costs. Cost of debt was included insurance and taxes in the moment because the property was still in Brandon's name. So the full PITI he was paying. We were given a 3-month runway to get the property turned around with very low expenses, putting some of our own money into the renovations to be able to get some apartments market ready and gain that momentum before we actually had to close. So that by the time we closed, by the time we had an appraisal, we were just trying to hide from the appraiser the number of apartments that were empty. But we gave him a full rent roll. We were just trying to hide the ones that hadn't been renovated from him yet and only show him the pretty ones. But we had, I don't remember exactly how many tenants we had by the time we closed, but it was in the teens, and we were in a much better position. We also shout out to another local Cincinnatian, Kurt Weil, who found us a phenomenal loan product from a great bank that gave us interest-only payments for the first year and a construction second to cover some of the bigger stuff like all new windows and sliding glass doors and resurfacing the parking lot that we weren't going to be able to just do from cash flows. But then we got the rest of the units renovated through mostly through cash flows as well as that construction second. And 18 months after we bought it, we cash out refied more than we had in it.
That is just mind blowing, because you listen to Bigger Pockets and you hear these deals that go through there, and all you hear about is how people are crushing it. And, this is no shot at Brandon or anything, but, not every deal is going to go perfectly, and in your instance, you were able to come in, assist him on both ends of the transaction, and turn a property that might not have been the best fit for him into a property that was extremely successful for yourself. And so I think a lot of people that listen to these podcasts go like, oh, I could never, I'm so far off from these people, where you come in and you're in a situation where you were able to do some things. One, because you were local, you knew the market. And, but number two, because, you just were able to come in and operate it successfully. So kudos to you there. And I think that's a great lesson for a lot of people who get caught up in the hype, so to speak.
A couple of things here about Brandon. First of all, he's given me permission to talk about it. He's also written about it in, I can't remember which book. I can look it up later if you want to just edit this little thing out. But Brandon made one mistake. He just didn't get the right management in place. Now, the property is in Cleves, Ohio, which you can Google how far away that is from Cincinnati proper, within the metro area, an economically depressed area that's kind of difficult to get to, all things considered. And a lot of the high caliber management companies were not interested in a property that small, that far away. So for a non-owner operator, there are some significant headwinds to this property in particular, but just straight up management. And he recognized that he just wasn't putting enough time into the management of, he wasn't putting enough effort into getting the right management, asset management or property management in place for this thing. The other is that we effectively bought it from him at break even from a P&L perspective, so that he was getting back out of the property 18 months, what he had put into it. It ended up being a significantly profitable deal for him, though, because he 1031'd into the property, he cost segregated it, and was able to 1031 back out again. And so from a tax perspective, the tax savings involved for Brandon in breaking even over a 24 unit in Cincinnati over 18 months was tremendous. I don't know the exact numbers. I don't know the tax implications to Brandon's income, but from a tax perspective, the things that he was able to do because he owned that property were significant.
That's another great point, because I think a lot of us out there see people acquiring assets at prices and we go, there's no way it's a deal. There's no way this makes sense. But even in the instance where Brandon wasn't necessarily making a killing on this property, he still benefited tremendously from owning that asset.
Yep.
Great, just great tidbit there. I know we're kind of getting long in the episode, but I wanted to kind of circle back, because something that you have now that you didn't have when you were first starting in 2013, 2014 is experience and just time. And you've had a family, transpire throughout this entire process. And one of the things I want to hit on is, what is it like now balancing your business versus when you first started? And like, what changes have you made so you could prioritize time with your family?
I got a couple of things here. One is that when it comes to the activity of real estate investing, I suck at almost everything. You would never hire me to manage the renovation of your apartment. Sure. To paint it? No, never. You would never hire me to fix anything other than possibly a broken tenant relationship, or lease agreement or something like that. It has been, this is something that Brandon Turner talks about all the time still, to go back to him, but it has been advantageous to me to suck at everything, because I have to find other people for that stuff. And so there are a couple of skills within real estate and real estate investing that I've really had to focus on the last few years. One of them is recognizing opportunity, whether it's a deal or a partnership or starting a company or something like that. Recognize opportunity. And the other is in managing people. Because I can't do the vast majority of stuff myself, I have to find other people to do it. I have had to learn how to find the right people, manage the right people, find the right people, lead the right people, manage the right people. So those are the skills that I've focused on, which means that honestly, right now, there are people who work for me and I have no idea where they are or what they're doing, because I also have hired someone else to be a renovation coordinator, and be the one who is getting in front of every maintenance request within a business day or within 24 hours or shorter if it's more emergent than that, more urgent than that. I've had to learn how to instead of just taking care of properties, take care of people who take care of my properties, and that means that while Slocomb is in his office talking to you and your listeners right now, Grant, Three Little Pigs, property management, construction management, and HVAC are all over greater Cincinnati right now, taking care of people and taking care of things for people. The only other thing I'll add to that is just on a very pragmatic day-to-day basis. It's always my goal now to leave the office by 5 o'clock. My office is a 5-minute walk away from home. So to get home a little bit after 5. And obviously getting home is what matters more than when I leave my office. If something is keeping me in my office past 5 o'clock, keeping in mind that almost all of the day-to-day operations of my real estate and my operating companies is being done by someone else. If something is keeping me in my office past 5 o'clock, something about my companies is broken and needs to be fixed, or something about my activity or my behavior needs to be fixed. And in the moment, usually that day, while I'm walking or driving home, I can figure out what it is that kept me in the office until 6, or kept me in the office until 5:30, or forced me to visit a property at 5:30 p.m. when I should be playing with my kids at home. All of those things that force me to work past 5 o'clock Monday through Friday, I immediately figure out how I can fix it and make sure that either someone else is doing it, we have a better system, or that I am more disciplined about getting it done faster.
I have 2 roundup questions I like to ask everyone before we get off the show. The first being, what's the best advice you could give to someone who's just getting started in real estate?
2 things. One is figure out your goals. And when I say your goals, I mean figure out the results that you want from real estate investing, the results from the time, the money, and the things you're taking time and money away from while real estate investing. Dial in what it is you want from doing all of this first. That's going to give you a lot of clarity when it comes to deal finding. It's going to give you clarity on what strategy you should be implementing, what activities you should and should not be taking. The next thing is, if you're new, there's a lot of stuff that you don't know that you don't know. So I would say on your first few deals, your focus, even more so than profitability, whatever kind of profitability you need, transactional flipping, capital gains, or if it's long-term buy and hold income or just depreciation over time. With your first few deals, put an equal focus on how you're expanding your comfort circle. Find one skill, one knowledge base, or one experience that you know that you will gain or add from your next deal. For me, the first deal was all about tenants, tenant relations, and a little bit about maintenance. The second deal was all about construction management with a BRRRR deal that required a lot of rehab. And then moving on from there, add a rung to your comfort circle with each of your first few deals, so that things that seem complicated to you, to stick with our Brandon Turner theme, in a couple of years for you, they'll just feel like a Tuesday morning.
Terrific. What's one way that our listeners can give back to you or help you where you're currently at in your business?
That's a great question. We're talking about these service businesses within real estate. So people who are local to Cincinnati, there are a lot of things that I do that add a lot of value to people. You can reach out to me about that. More generally speaking, I really love adding to my network, adding to my sphere of influence. One of the things you talked about, I don't remember the words you used specifically, but I really enjoy being a connector, knowing a lot of people and helping connect the people who can benefit from knowing each other. Garth Kukla, another mutual friend of ours, he and I started a real estate investor poker game in 2016 that used to religiously meet once a month just to play poker, which was more about bragging rights and talking smack, but also about the camaraderie. The financial outcome of that poker game was never really significant for any of us. But the number of relationships, professional, personal, the number of deals that have not crossed the table literally in the moment, because we're just there to jaw jack each other. We're not actually trying to transact real estate at the poker table. But the amount of gain that there has been for each of the people who've played poker and stuck around with us for the last few years has been tremendous to see. So if you want to get connected in the real estate investing space in Cincinnati, I'd be more than happy to connect with you. And I think Grant has my LinkedIn, Facebook, my email, and he asked for a website, so I gave him my property management website.
Beautiful. Yeah, Slocomb, again, thank you so much for coming on the show and being exactly what you just discussed, which is, the conduit for so many investors to get started investing here in the real estate community in Cincinnati.
Grant, I appreciate it. You got like a full hour out of me without cracking any jokes about you. I had something planned too, but you very masterfully navigated this conversation to make sure I didn't make fun of you too much.
I made sure there were enough spaces in there to where I could just navigate and get by them. So, but that's all for the show. If you want to get in touch with Slocomb Reed, we're going to be posting his contact information in the description of this podcast, YouTube video, wherever you're watching or listening. If you've listened all the way to the end, then please leave the show a raving review so we can continue to spread education, inspiration, and wisdom to all the investors listening to help them build wealth in real estate. We will see you in the next one.